Today is the 40th anniversary of the end of the gold standard, but 4 decades on, gold has never been more popular, last week rising above $1,800 an ounce for the first time ever. It remains the safe haven of choice for investors. To discuss gold's role as a global reserve asset, I'm joined by the World Gold Council's Director of Government Affairs, Natalie Dempster. She joins me from the London Stock Exchange. Natalie, thanks for joining us. Are we likely to see a return to the gold standard, or are we actually seeing one in an unofficial capacity already?
I don't think we'll see a formal return to the gold standard. The gold standard broke down back in 1971, but informally, what we are seeing is you're right, is private investors trading in fiat currencies for gold, and I think for very good reason. There's a lot of concern that inflation's coming. We have the possibility of the third round of quantitative easing from the Fed now, and people are understandably concerned about the value of their fiat currencies declining. Gold is ultimately the only currency that you cannot print more of.
Well, if that's the case, why won't we see a return to the gold standard?
A return to the gold standard would require political agreement at a global level, and I think that would prove insurmountable. We see the difficulties that even Europe has on political agreement at the moment, and I think to get one globally would be very difficult. Central
banks are now major buyers of gold, and it's established itself as a reserve asset. Do you expect this trend to continue?
Yes, absolutely. You're right. Central banks have been buying a lot of gold recently. For 2 decades, they had been net sellers of gold. They returned to be net buyers last year to the tune of 76 tonnes. So far this year, they've brought more than 3 times that amount. That reflects rebalancing because they've had such strong growth in foreign exchange reserves. Gold's share in their reserves has declined, but it also reflects the same concerns that other investors have about inflation and about the value of the dollar. And of course, central banks don't have the option to go into the equity or the hedge fund market. Their investment guidelines are typically fairly restrictive, so it's government debt, quasi-government debt, or gold. And in the environment where you're even seeing the US lose its AAA status and the sovereign debt crisis is worsening in Europe, you would expect them to continue to buy gold.
Thailand and South Korea were the latest countries to increase their holdings. Which countries would you expect to follow?
Well, a lot of countries in Asia have been buying. It's been China, India, Russia, as you say, Thailand and Korea. I think look at the countries that have the strongest growth in their foreign exchange reserves, because they're the countries that require the diversification that gold can give them.
But that said, there are problems with central banks and gold, not least the size of the market. It's a very, very, very small market compared to, say, foreign exchange, for example. What sort of obstacles do you see there going forward?
No, it's not a small market compared to the Eurobond markets. In fact, gold trades, we estimate $120 billion a day, which would make it more liquid on that basis than either the gilt or the bond market. The gold market is sufficiently deep and liquid for central banks to be in the market, which is why in the West, they've held 60–70% of their foreign exchange reserves in gold.
OK, then, what about the price then? I know you don't want to talk about the price specifically, but at what point does gold become too expensive for central banks and reserve asset managers when they might start to look elsewhere for other assets?
Well, gold acts as a diversifier for them. I mean, that's why central banks buy gold and investors buy it, because it gives them, protection against fat tail events. And I don't think that the price point necessarily matters for that. It's how gold reacts to a shock.
OK, we've been talking about buying gold. I just want to finish up with when central banks and asset managers might sell gold. At what level of gold and price is it attractive for them for the indebted nations especially, to sell gold to pay down their debts?
Well, firstly, gold is held and managed by the central banks rather than by the government. I mean, you hold reserves for things like the management of your currency and protection of your currency in times of stress, rather than to pay government deficits off.
So you don't expect this to happen? You don't expect indebted nations, governments to lean on their central banks to sell gold to pay off their deficits?
Absolutely not. Most central banks are independent of government interference.
Natalie Dempster, thank you very much. That's where we'll have to leave it. That's Natalie Dempster from the World Gold Council. I'm Jamie McGeever, and this is Reuters.